Welcome to the deep dive. Our mission today is, well, it's to try and make sense of the absolute chaos that was October 2025. We're digging into the latest magazine issue, which really captured a month defined by extreme volatility, but also some serious geopolitical clashes. It tested pretty much every asset class, didn't it?
It really did. October felt like a collision event. You had the things we sort of expected, like the Fed signaling easing, but then that just slammed right into the unexpected. The U.S. government shutdown, that crypto flash crash, the U.S.-China summit, it all happened at once. So today, we want to get past just the headlines and give you the data-driven insights, the stuff you actually need to navigate this final quarter.
Okay, let's start with a quick pulse check. What were the markets actually doing? FX, for instance, the dollar stayed weak.
Yeah, continued weakness. The USD index dropped 1.2%. There's just so much uncertainty around the Fed's next move. But interestingly, Europe showed some real strength.
Right, that resilience narrative we've been tracking. So
Yeah.
Euro USD and GBP USD were up.
Yes, exactly. Euro US gained 1.8%. GBP USD added 1.5%. It's a clear signal, I think. While the U.S. was stuck in that shutdown paralysis, the Eurozone was managing to shake off some risks. That created a pretty obvious policy divergence trade.
Okay, then crypto. Woof. Bitcoin had its worst October in, 10 years? Down 5%?
Yeah, and the headline number,
Oh, wow.
that catastrophic $370 billion market cap wipeout on October 10th and 11th.
370 billion. That's staggering.
It really is. The fear and greed index just plummeted. I think it hit 29, deep into fear territory.
Was that the biggest liquidation event ever?
It was the largest single-day liquidation event we've ever tracked in digital assets.
Yeah.
But here's the nuance, the important part. Despite that massive flush,
Mhm.
there were pockets of strength. Hyperliquid, XRP, they actually posted decent gains.
But hang on, after a $370 billion hit, how did it recover so quickly? Was that just like retail FOMO, or is there something more solid driving that buy the dip mentality?
No, it wasn't reckless optimism. Our data points to highly targeted institutional money coming in. That quick snapback from Bitcoin's low, around 104K, it showed that once that huge liquidation cascade finished, which often cleans out the over-leveraged retail traders, the big players were ready. They were poised to deploy capital. For them, that kind of flush is almost an entry signal, not a red flag.
Interesting. Okay, shifting to stocks. S&P 500 was hovering near record highs, seemed almost detached from reality.
Well, it was resilient, but almost entirely driven by that AI momentum.
Yeah.
NVIDIA had a $4.5 trillion valuation during the month. It's just incredible.
4.5 trillion.
Yep. And that AI dominance, it created this very selective rotation. You saw extreme volatility elsewhere. Indian stocks, for example, they dominated both gainers, like Tata Steel up 4.5% and losers, Trent down 4.2%.
So stock sentiment resilient but picky. FX cautiously neutral because of the Fed uncertainty.
And the data blackout, yeah.
Crypto was just fear
Secular
dominated
growth.
after that crash. Right, let's unpack that paralysis you mentioned. The U.S. government shutdown. It dragged on for 30 days. Why was this shutdown different? Why wasn't it just political theater?
Good question. Because this one caused real structural damage. Three main reasons, really. First, the data blackout. The BLS, the Bureau of Labor Statistics, they suspended everything. Jobs reports, CPI, GDP estimates, gone. The Fed was forced to operate completely blind, making informed policy impossible.
Flying blind is bad enough. What was the second point? Something about jobs.
Correct. The threat of permanent job losses.
Correct.
The administration actually signaled that up to 300,000 federal workers might face permanent layoffs. Now, that changes everything. It's not just a temporary furlough anymore. It's a genuine structural shock to employment. It hits consumer confidence hard and damages government capacity long term.
Okay, data blackout, permanent job loss risk, and the third one, consumer spending.
It's exactly the SNAP crisis. SNAP, Supplemental Nutrition Assistance Program, food assistance. Over 40 million Americans were set to lose those benefits for November. That's just an unprecedented shock to consumer spending. It would ripple through retail, groceries, staples, everything.
And that explains the divergence you mentioned earlier, right? Tech stocks are resilient, maybe artificially so because of AI, while commodities like copper and oil and crucially credit spreads were pricing in actual recession risk.
Precisely. That widening in investment-grade credit default swap spreads, the CDS spreads, that's critical. CDS is basically insurance against default. When U.S. sovereign CDS spreads widen, it means the market sees more risk in U.S. governance, U.S. solvency. It strongly suggests that international confidence is starting to erode. That's a big deal.
Okay, so domestic paralysis leading to potential international confidence issues. Let's shift to the international stage directly. The Trump-Xi summit in Busan. Trade truce? Or just kicking the can down the road?
I'd call it a temporary tactical respite. Definitely not a fundamental resolution. The main achievement, the win, was the rare earths truce. China agreed to suspend export restrictions on those critical materials for 1 year.
Okay, 1 year. That avoids an immediate supply chain catastrophe for tech. Okay.
It does. And Trump gave a little back, reducing tariffs from around 57% down to about 47%,
Hmm.
modest.
But the core conflict, the tech war, that's still on.
Oh, absolutely. The U.S. explicitly did not suspend export controls on those cutting-edge Blackwell semiconductor chips. That's key. The battle for dominance, especially in AI, is fully engaged. The market reaction was pretty muted, which tells you there's skepticism, and the risk here is highly asymmetric. If this truce falls apart by mid-2026, which it easily could, we could see a huge market correction, 15–30%.
Wow. Okay, now connecting this back to central banks, this is where the divergence gets really stark, isn't it? The Fed cut rates.
Yeah, 25 basis points, moved the target range down to 3.75% to 4.00%. But Chair Powell was incredibly cautious in his language. He basically said a December cut is far from assured.
So the headline cut was small, but wasn't there something else significant happening with their balance sheet?
Yes, absolutely. That was arguably the real policy easing. The Fed decided to cease quantitative tightening, or QT, starting December 1st.
Okay, break that down. Ceasing QT. Why is that such a big deal if the rate cut was small?
Right, so QT is when the Fed shrinks its balance sheet, it lets bonds mature, it doesn't replace them. It's effectively pulling money, liquidity, out of the financial system.
Yeah.
Stopping QT means they stop pulling that liquidity out. Even without a big rate cut that injects stability, it eases financial conditions. It's a genuine structural shift driven by stress they were seeing in money markets.
Okay, so the Fed eases, albeit cautiously and structurally with the QT stop. Meanwhile, across the Atlantic, the ECB.
Held steady, kept their deposit rate at 2.00%. They cited Europe's resilience, slightly reduced geopolitical risks, and that policy divergence is exactly what kept supporting the euro against the dollar. That 1.8% gain in euro USD makes perfect sense in this context.
We also saw some interesting political signals out of Europe. The Netherlands election.
Yeah, a win for the center-left D66. They pushed back against the far right. For markets, that meant a reduced political risk premium for the Eurozone, which helped the currency too.
But not all positive news for EU alignment, right? The Czech election?
No, quite the opposite. Andrej Babis and his ANO party returned. That signaled voters pushing back against EU-aligned policies, mainly driven by anxiety over energy prices and the costs of the green transition mandates. It highlights the growing economic fractures within the EU bloc itself.
Lots of moving parts. Before we get to the investment takeaway, were there other big international meetings we should quickly touch on?
Yeah, a few key ones. The World Bank and IMF annual meetings were heavily focused on debt relief for the Global South. That's becoming a critical issue. We saw the EU trying to reassert influence in the Middle East via an EU-Egypt strategic summit, and maybe most importantly, the APEC summit. That was really defined by Asia trying to figure out how to handle trade fragmentation, building regional ties while the U.S. and China keep sparring.
Okay, so distilling all of that chaos, what are the key takeaways for traders trying to navigate this, especially the risks?
Right. Number one, valuation risk. It's severe, particularly in the U.S. The S&P 500's forward PE ratio is at 22.6.
Yeah.
Historically, you only see levels like that during major bubbles or massive tech hype cycles. It suggests the upside is really limited, but the downside. That correction risk is definitely not priced in. Classic asymmetric risk.
And gold, I mean, the move was just incredible, up 64.6% month to date.
Astonishing, wasn't it? It just reflects the market scrambling for insurance against political dysfunction. Central bank buying was a huge factor, too. Goldman Sachs certainly noticed. They raised their 2026 target for gold. That's $4,900 an ounce.
4,900, wow.
Yeah. So for traders, the implication is clear. Disciplined sector rotation. You probably want to avoid sectors heavily reliant on government spending, like defense contractors, government IT, given the shutdown risks. Instead, favor areas like technology for the AI momentum, healthcare, and consumer staples, which tend to be more resilient.
So the market stabilized a bit, but it's flying partially blind because of the data blackout. What are the specific November 2025 catalysts that will force its hand, that will give us some clarity?
It really comes down to getting that delayed data back online. Two dates are absolutely critical. First, November 7th. That's when we expect the delayed October U.S. employment report, crucial for understanding the labor market, consumer health. Second, November 13th. The delayed October U.S. CPI report. This is the big one for inflation. It will likely determine whether the Fed feels it can risk another rate cut in December. Those two data points will basically decide if this fragile stability holds or if things get rocky again.
Absolutely. And navigating this kind of volatility underlines why having a disciplined strategy and, frankly, the right tools is just non-negotiable these days. Which brings us nicely to our community corner. Before we look ahead, we wanted to share some real-world results and announce something new. The exclusive member area on s1mag.com is now officially live. It's free for all our community members. You just need to register.
And that member area is where you'll find some of the cutting-edge tools that help drive the successes we tracked this month. We're talking about agentic AI, like MPA v3.1, which is designed for market analysis and executive reports, and Anti-Radar v1.1, that's an AI-powered asset scanner. Think of it like sonar for finding institutional flows.
And these aren't just theoretical tools. They underpin real success stories, like at Frank Castle, who, after a 5-year journey focused on mentorship and rigorous risk management, finally secured his first payout. That's fantastic.
Absolutely. And the resilience shown by Ed Angie, recovering an account from a nearly 10% drawdown, 9.6% I think it was, on gold and silver, that takes serious skill and nerves.
We also saw at Sayed 31, a really versatile trader, conquer 2 different prop firms. An incredible speed from at HBNDB, going from newcomer to funded with Top Step in just 1 month using a disciplined hybrid approach.
It really shows the power of combining fundamentals, technicals, and robust risk management. It's about a scientific approach, not just guessing.
And that scientific rigor is constantly evolving within the community. For instance, a member at RevBin01 developed something called PropSim.
Ah, yes, PropSim. It's a new simulator, very clever. It uses quasi-Monte Carlo simulation that's advanced statistical modeling, runs 100,000 simulations based on your trading history, and gives you a statistical probability of passing a specific prop firm challenge. It's about knowing your odds.
That's incredibly useful. And the AI tools you mentioned, MPA and Anti-Radar, they were actively used this month.
Oh, yeah. At Azimel87, leveraged them to analyze institutional flow and retail positioning. They flagged some high-conviction opportunities, notably identifying long USD CAD and short NZD into USD as prime setups based on that data. Real-time, practical application.
Another tool making waves is from at Revins1, again, right? The Pull Levels dashboard.
That's right, the Pull Levels Risk Dashboard. It's a really practical MT5 indicator. It automatically calculates your lot size, potential profit loss, and your risk. Reward ratio, all in your account currency. Makes superior risk management much easier to implement consistently.
Fantastic community contributions. Okay, wrapping up the magazine highlights, the technology section had some really crucial nuggets people need to be aware of. First, the new S&P Digital Markets 50 Index. What's the significance there?
It signals crypto's formal institutionalization. Digital assets are being formally integrated into mainstream investment frameworks. It's another step towards broader adoption.
And something called ISO 2022? Sounds technical, why should we care?
Because it's the global financial plumbing upgrade. Nobody talks about it, but it's huge. It standardizes financial messaging, worldwide think payments, securities transactions. It makes cross-border payments faster, cheaper, and vastly more data-rich. It fundamentally changes how money moves around the planet.
Okay, so looking back at October, the final pulse showed markets kind of stabilizing after some major shocks, but it feels incredibly fragile, doesn't it?
Extremely fragile. And here's that final provocative thought for you to consider. That combination of the U.S. dollar declining during a crisis, paired with U.S. sovereign CDS spreads widening. It really suggests that international confidence in the stability and reliability of U.S. governance might be structurally eroding, not just a temporary blip. If that's true, it demands serious thought about portfolio diversification, maybe increasing allocation to things like gold or even certain digital assets as a hedge against long-term political fragmentation risk. That risk is now a material market factor you can't ignore.
A sobering thought to end on.
Okay.
Okay, just a reminder before we wrap up, you can download our magazine entirely for free, this issue and all the past issues at s1mag.com. The magazine is available in 3 languages, English, French, and Arabic, and it comes out monthly. We also publish a monthly deep dive like this one, discussing the magazine content on our YouTube channel. If you're passionate about finance and want more frequent updates, definitely follow our TikTok channel, AnyTrader Hub. And finally, if you're looking for a professional-grade community of traders, a place to exchange ideas, learn trading based on data and science, not just dreams, then please visit our website, anytrader.com. You can learn more about us there and see how you can join our community. Thanks for tuning in.